Number 4, trading fees and slippage. This is for the active trader, and active trading on your own is the fastest way to lose money. You can have a better look at this on my equities trading article, where I really get into depth on trading specifically. But basically, if you're trading on your own, you're going to have way higher fees than the average professional trader. The prop trading company that I worked for, at one point, we were making, it was like a cent or two per trade. Per 100, 200 share lots, we're paying like 2 or 3 cents. So it was, incredible fees that we were paying. That was because our company had this massive amount of leverage with the clearinghouse, and we were doing massive volume, so they could negotiate these incredible rates with the exchanges. However, the average guy on E-Trade, $10, $12, $20 a trade, horrendous trading fees. And then you've got slippage. So let's say you've got a trading system that you're operating on, and you've back tested it for the last 3 years, and it's looking good. It's doing 20% a year. But when you actually put it into practice, when you go and try and buy the stock, you're going to get the stock at 20, 30 cents away from where you want it a lot of the time. And then when you sell the stock, you're going to get it 20, 30 cents away from where you want it, because you've got to buy from the offer, and you've got to sell to the bid. A lot of the time, if you want to get out exactly where your stop loss is going. So on the way in, the way out, you lose a certain amount of your trade. And if you're trading in like a tight range, 20, 30 cents in and out is going to cost you a lot of money. If you're on like a 3-4 year cycle where you're holding stocks for a longer period, it's going to be negligible. But if you're doing swing trading, or you're changing positions every week or every 3 days, that slippage is going to add up in a major way. After I quit day trading, I had a system that was, a swing trading system that would have made me a decent amount of money. But in practice, I was getting lit up on 20, 30 cents each way. I wasn't able to get the fills that I used to get as a day trader. E-Trade, it was just a terrible setup, and the slippage and the trading fees killed that particular system. So when you're looking on your charts, the system that you see and that you've built out, you're going to have to take away 30, 40 cents off every trade if you want to make that a realistic system, and you're going to have to include the trading fees, and that really works against you. Number 5, carrying cost of leverage. So leverage is the credit extended to you from your brokerage house, and unless you're already wealthy, not only will you be not extended very much credit, but you're gonna have to pay. You're gonna have to pay the cost of the interest on that. When I was a prop trader, the company that I worked for handled all the leverage. I didn't have to put up any cash. I just had to pay them 40 to 60% of what I made, and they had massive leverage with the clearinghouse. I was able to get upwards of, I had $3 million in buying power to play with every day by the end of my run, and I didn't have to pay a dime of carrying costs on that. The company would handle it. But for you average traders, you're gonna have to pay that. And when the market's moving against you and you're getting lit up, that's when the broker calls start coming. So you're gonna have to pay for the leverage, and then you're gonna get calls from your broker when it's the absolute worst possible time, when your portfolio or whatever you're trading is getting beaten. That's when you're gonna get calls to pay up for that. So you got to deal with that as a factor.